Hello and welcome. In this video, I'll briefly explain the different kinds of education loans available for Indian applicants for their higher education abroad. Now, the objective of this video is not to promote any particular type of loan or any particular loan provider, but the objective here is to give you an understanding of the requirements and the features of the various kinds of loans so that you can make a well-informed decision when choosing your loan provider. Now, broadly speaking, there are three types of education loans that are available. One is the collateral based loan, then there are non collateral based loans, and then there are loans which are available in US dollars. Now, as you can see on the screen, collateral loans require you to keep some kind of collateral, which is preferably a property, as mortgage with the bank. Non collateral loans do not require you to keep any kind of collateral with the bank, but then they require you to have a cosigner. A cosigner is more like a guarantor for your loan, and most institutions that offer non-collateral based loans require that parents should be the guarantors for the loan. There are some institutions that would also accept maybe a sibling, like a brother or a sister who is an earning member of the family, or then maybe even an uncle or aunt as your guarantors. But most loan providers prefer that parents should also be your guarantors. And then there are loans which are offered in US dollars. Now, these loans are also non collateral based loans, and some of them don't even require you to have any cosigner as a guarantor for the loans. So, they are basically offered on your own merit. And of course, there are certain universities that these loan providers support, and only if your admit is from a particular university that they support, they would then give you a loan. Now here I have listed out some of the popular loan providers under each category. Again, this is not a very comprehensive list. There are other loan providers as well. But some key features that you need to understand is that Indian banks, especially the nationalized banks and cooperative banks, they generally offer only collateral based loans. Now, some banks do offer non collateral based loans as well, but then the amount that they offer as non collateral loans are very small. For example, say a state bank or even a Bank of Baroda, generally for a collateral based loans, they offer up to 50 to even 75 lakhs of loan. But when it comes to non collateral based loans, they offer only 7.5 lakhs. If you're looking for a non collateral based loan, then the best options are the NBFCs or some of the private banks, say an Axis Bank, IDFC, HDFC Credila. These are the ones that are very popular and offer very comprehensive rates for non-collateral based loans. But then they all require you to have a cosigner. Now, a cosigner is generally a parent, or sometimes some of them might even accept a sibling. They would be checking the credit history of your cosigner as well as the financial background of your cosigner. And if you're, some of these institutions also check your profile. Like they'll be checking your academic profile, which university have you been admitted, which course have you been admitted to, and as well as some of them check your test scores like your GRE, GMAT, TOEFL, IELTS scores. And if they feel your profile is good enough and you have a good cosigner, they can offer you an unsecured loan, that is a loan without any collateral, up to 75 lakhs as well. And then the third category are the US dollar loans. Now, the most popular ones in the US dollar loans are Prodigy Finance, Empower, and Leap Finance. Empower and Prodigy offer you loans even without a cosigner. That is, they don't require you to have any collateral, and they don't require any cosigner either. Leap Finance, however, as of today, requires you to have a cosigner, but they don't require any collateral. As far as rate of interest go, collateral loans are the cheapest. The rate of interest for a non-collateral based loan is generally 2 to 3% higher than a collateral based loans. Similarly, the rates for US dollar loans is also comparable to a non-collateral loan. Now, an important question here is which type of loan should you prefer? Now, if you have collateral that you can keep as security, you can definitely opt for a collateral based loan. Now, banks accept property as security. Many banks will require a freehold property. Some banks do accept land if it is a non-agricultural land, but very few banks would accept agricultural land as security. So if you have security that you can keep as mortgage, you can definitely go for a collateral based loans. Banks also accept fixed deposits as security, but then again, whether to take a loan against those fixed deposits or just break those fixed deposits and use it for your education is again your call. Now, whatever be your collateral, the banks would give you a loan up to maximum of 80% of the value of the collateral. This is a general rule that most banks follow. Say, for example, you have property whose market value is approximately 80 lakhs. Then you can get a loan up to say 60 to 65 lakhs. So that is the kind of education loan that you can get against that property. But if you have a property whose market value is only 40 lakhs, then the max loan that you can get is only say 32 lakhs. So again, depending on the value of your property, you can then decide whether the loan that you can get against that property is going to be sufficient for your education, and then you can take a call whether you need to go for a collateral based loan or a non-collateral based loan. Some banks would also do a combination of both. I mean, they would give you some loan, like some of these private banks would do that, or even the NBFCs do that, where they give you partly a collateral loan and partly a non-collateral loan. So you can explore that option as well. When you discuss the loan options with your loan provider, you can tell them about this. Now, if you don't have any collateral to keep as security, but you have a co-signer, then you can definitely try the NBFCs or the private banks for a non-collateral based loan. That can be an option that you can explore. But if you don't have either a collateral and you don't have a co-signer, then obviously the dollar loan only becomes the dollar loan becomes your only option. So you can then try for companies like Prodigy or Empower Finance, where you can get these loans. Leap also offers good education loans, but as I said earlier, as of today, they still require a co-signer. Now, a thing about these dollar loan providers, especially Prodigy, Empower, and Leap Finance, is that they offer an education loan only if your acceptance is from a university and program that they support. On their websites, they have a list of universities and programs that they support, and if your admit is from one of those programs, only then they would offer you a loan. If you have been admitted to a university and a program which is not supported by them, then they would definitely not offer you an education loan. Now, a question that students often ask is that if you are getting a loan in Indian rupees as well as a loan in US dollars at a comparable interest rate, which one should you opt for? Now, this is something that you will have to decide, but I'll briefly explain what is going to be the difference between borrowing in Indian rupees versus borrowing in US dollars. Now, say for example, you have to pay $10,000 to a US university. Now, if you want to borrow in Indian rupees, that is, your loan is in Indian rupees as of today, and the rate of the dollar to rupee conversion is say 80 rupees per dollar. Today, you will have to spend 8 lakh rupees to get that $10,000. Now, 2 years down the line, when you graduate or when you are ready to start paying your education loan, if the dollar rate has increased, that is, the dollar has become 85 rupees per dollar then in that case, $10,000 will actually get you 8.5 lakh Indian rupees. But at that point, if the dollar has decreased, that is, the dollar has gone down to $1 to 75 Indian rupees, then $10,000 will fetch you only 7.5 lakh rupees. So, if the dollar rate increases by the time you graduate and you are ready to pay off the loan, then you are at an advantage by borrowing in rupees and paying off at a later stage by earning in dollars and converting that to rupees. In case you are borrowing in dollars, that is, you're going for a dollar-based loan, then any kind of fluctuation between the Indian rupee at this point versus that of 2 years down the line will not affect you at all. I mean, you may not even get the benefit, but if in case the dollar rate decreases, you won't be at a disadvantage either. So this is a call that you will have to take, whether you should go in for a loan in Indian rupees or you should opt for a loan in US dollars, assuming that both options are available for you and the interest rates and other factors are comparable. So in short, these are the factors that you should consider when applying for an education loan. Of course, the first is whether you have collateral and would you like to keep that as security with the bank. Do you have co-signers? Then what is the loan amount that you actually require? Now for that, you will have to kind of estimate the cost of your education and then decide how much of it would come from your and your parents' side and how much would you want as education loan. Say for instance, some students might say, okay, my cost of education is estimated at 50 lakhs, but 20 lakhs is what my parents would pay and I would need an education loan of only 30 lakhs. Whereas some students might want the entire amount of their education and living to come through an education loan. So based on that, you can then decide whom to approach, because every education loan provider, I mean the banks, NBFCs, have also limits on the maximum amount that they can provide. Because another very important factor is the rate of interest that is being offered to you. What are the rates of interest that banks are offering versus NBFCs are offering, and what is the rate that if you're applying for a dollar loan, then what is the rate that they are offering? You can always, get quotes from various providers and then take a call on that. Another important factor that you need to consider is the processing fee. Now, all banks, NBFCs, the US loan providers would charge you a processing fee. So you need to understand what is the processing fee. Is it going to be on the loan sanction amount or is it going to be on the loan borrowed amount? Also, at what point do you have to pay that processing fee? Whether you have to pay it upfront or would you have to pay it as part of your loan? That is, some banks or some financial institutions would add the processing fee amount to your borrowed amount rather than charging you that amount upfront. So that should be one important factor that you should consider before you finalize on your loan provider. Another factor that you should consider is the margin money percentage. Now, many banks in India charge you a margin money which could be as high as 15 to 20%. Now, what this means is that every time you make a demand for a disbursement, the bank would ask you to first pay the margin money equivalent component and then they would pay the rest. Say, for example, you raise a demand for 10 lakhs to be sent to the university. The bank, and if your margin money is say 15%, the bank would say you first pay the 1.5 lakhs and then they would disburse 8.5 lakhs. So this is a factor that you will have to consider when you finalize your loan, on whether you have this kind of fund available to pay for the margin money every time you raise a demand for a disbursement, or you don't have this money. In case of NBFCs or even the dollar loan providers, the margin money is negligible and in many cases it is even 0%. So the entire cost of your education can be covered with an education loan. Whereas if you go with the banks that have a high margin money, you will have to keep aside some money with you or your parents who can then make the margin money payments every time you request a disbursement. Another factor to consider is the moratorium period. Now, almost all loan providers give you a 2 to 2.5 years of moratorium period. What this means is that while you are studying, that is during the 2 to 2.5 years period when you are studying and searching for jobs, you do not have to make any payments to the bank. Your EMIs would start after this period. Of course, you can always start it early in case you finish your course early and get a job and you want to do that. But until this period, you need not pay if you do not want to pay. Some banks, however, would still ask you to make the interest payment, that is only the interest payment and not the principal amount, during this period. Some banks will give you that option. Now, you will have to check with your bank or a loan provider on what are the terms for moratorium period, whether they require you to make the payment during this moratorium period, that is, they require you to pay the interest during this moratorium period, or that can also be accrued towards your loan payment. That is, it can be added to your principal. Now, banks and NBFCs that would require you to make this payment during the moratorium period would generally calculate the interest based on a simple interest method during this moratorium period. But again, before you finalize your loan provider, check with them on whether a payment is required during this moratorium period, how is the interest going to be calculated, what is the minimum payment that is required. It would again depend on you and your parents whether you want to make the payment, you have the capability to make the payment, or you do not want to make any payments during the 2 years of your education and want to start your payments only after maybe 2 to 2.5 years when you start working. This is something that you will have to decide for yourself. Another thing that you need to check with your loan provider if there are any prepayment penalties on the loan. Now, most loan providers do not have any prepayment penalties, but it's always a good idea to check with them or to read the terms and conditions to see if there are any prepayment penalties. Now, in case your parents are going to make the loan payments for you while you are studying or even later, they may be eligible for some tax benefit under Section 80E. Now, this is possible only if your loan is from a bank, and the only NBFC that would allow you to claim benefits under Section 80E is HDFC Credila. If you are going for a loan from any of the other NBFCs or maybe a US dollar loan, your parents or you will not be eligible for any benefits under the Section 80E. But again, if your parents' income is not that high that they can take advantage of the tax deductions under Section 80E, or then they opted for the new tax regime under which you cannot claim any deductions, be it Section 80E or any other deductions, then in that case, this factor may not be a very important factor for you. But either way, I mean, in case you are able to take advantage of the tax savings under Section 80E, then you might want to consider this also as a factor when choosing your loan provider. I hope this gives you a basic idea on the various types of loans that are available and what are the factors that you should consider when finalizing your loan provider. As I mentioned earlier, there is no one type of loan or one loan provider that is a good fit for everybody. Based on your profile, your requirements, your and your parents' financial health, and several other factors, you should then decide which is the best type of loan that you would like to opt for and who should be your loan provider. In the description of this video, and as you can see on the screen, I have provided a link. If you would like, you can just go and enter your profile details there. And within a few minutes, you would get quotes from some of the leading loan providers in India. Again, this is a completely free service. If you want to try it, definitely do that. And if you need any further assistance, feel free to get in touch with me. Now, as a closing remark, here is a secret that I would like to tell you. And that is, you can always bargain with your loan provider. Often, students just accept the rates that the loan providers, that is the banks or the NBFCs offer them. But you can go back to them and tell them that I want a loan that is slightly cheaper. You can also bargain on the processing fee. Now, not that every bank or every NBFC would accept it, but you can at least give it a try. Also, if you have a loan offer from one NBFC or one bank, you can take that offer and show it to another bank and ask them if they can give you a comparable or lower offer. Now, that is also possible, and sometimes that works. So don't just go ahead and accept the first offer that you get. As I said, if you want to try out the link that I have posted in the description, definitely do that. That way you can get multiple offers from various NBFCs and banks. You can then decide which is the best for you and then go ahead with them. And even then, try to bargain with them and see what is the best offer that you can get. If you need any further assistance or any further information, feel free to get in touch. And I hope you like this session. Thank you for watching and do subscribe to my channel. Thank you.